Hey, Alex here again. We're on Chapter 7 of Accounting 201. This is inventories. So we'll start off with the introduction. Assume that in September you purchased a Sony HD plasma television from Best Buy. At the same time, you purchased a Denon surround system for $339.99. You liked your surround system so well that in November you purchased an identical Denon sound system on sale for $349.99 for your bedroom TV. Over the holidays, you moved into a new apartment and in the process of unpacking discovered that one of your systems was missing. Luckily, your renter's or homeowner's insurance will cover the theft. The policy is going to cover that theft. But the insurance company needs to know the cost of the system that was stolen. Now, the systems were identical. But to respond to the insurance company, you will need to identify which of the systems was stolen. Was it the first system that was $399? Or was it the one that was $349? Whichever assumption you make determines the amount of money you're going to get from the insurance company. So merchandising businesses such as Best Buy make similar assumptions when identical merchandise is purchased at different costs. For example, Best Buy may have purchased thousands of Denon surround systems over the past year at different costs. So the same system, multiple costs, because costs change. At the end of the period, some of the Denon systems will still be in the inventory, and some will have been sold. But which costs relate to the sold systems and which costs relate to the Denon systems still in inventory? Best Buy's assumption about inventory costs can involve large dollar amounts, and this can have a significant impact on the financial statements. For example, Best Buy reported $4,753 million of inventory on February 28, 2009, and net income of $1,003 million for the year. This chapter discusses how such issues as how to determine the cost of merchandise in inventory and the cost of merchandise sold. However, this chapter begins by discussing the importance over control of inventory. So, what's more important than keeping track of inventory is protecting it. So control of inventory. The two primary objectives of control over inventory are as follows: safeguarding the inventory from damage and theft, and reporting inventory in the financial statements. So the controls for safeguarding inventory begin as soon as the inventory is ordered. The following documents are often used for inventory control: the purchase order, receiving report, and vendor's invoice. So if the receiving report, purchase order, and vendor's invoice agree, they all match, the inventory is recorded in the accounting records. Then you can record the transaction. You can record the inventory. If any difference exists, they should be investigated and reconciled. So that's when you know something's up. Something might be either an error or something's fishy going on. Basically, a purchase order is basically the packing slip. That's the order you put in to have to get the merchandise. The vendor's invoice is what they bill you, and the receiving report that's basically the packing slip. That can be, usually you'll get the packing slip, and that can be your receiving report. If recording inventory using the perpetual inventory system, as discussed in Chapter 6, is also an effective means of control, because the amount of inventory is always available in the subsidiary ledger. Remember, we keep track of costs as we sell them, and we keep track of inventory as we sell it. Very good. Finally, the controls for safeguarding inventory should include security measures to prevent damage and customer or employee theft. So, store inventory in areas that are restricted to only authorized employees, locking high-priced inventory in cabinets, and using two-way mirrors, cameras, security tags, and guards. This is going to help. And the thing about it is sometimes you can't always prevent all theft or all loss, but just having these small things in place can sometimes prevent the majority of them. Because somebody who wants to steal from you might go, "Ooh, they got cameras, they got security tags, they got guards. I'll go to someone else." They're going to pick on an easier target. So never make yourself an easy target. when it comes to inventory. Just do normal procedures to help limit how much the loss you'll have. So you should do a physical inventory count of the inventory at year end to make sure that the quantity of inventory reported in the financial statements is accurate. So you always want to do a physical count at the end just to compare and to record shrinkage or whatnot. Okay, there's 3 inventory cost flow assumptions. There's first in, first out, FIFO. And basically, cost flow is in the order in which costs are incurred. So FIFO is you get the goods, you keep getting new goods, but you're always selling the old goods. So the illustration they have is they have a building, purchased goods go to the top, sold goods go out the bottom. Because you're selling the older goods, but you're stacking up the newer. So newer doesn't get sold, older gets sold in FIFO. In LIFO, it's the exact flip. In LIFO, cost flow is the reverse order in which costs were incurred. So in FIFO, they have a building illustration, and purchase goes in, sold goes out, right at the top. Because as soon as you buy new stuff, you sell new stuff. You don't sell the old stuff. So you're going to have layers of older merchandise. And then, my personal favorite, average cost, which is also what QuickBooks uses. The cost flow is the average of the cost. So in this illustration, your purchase goes to the top, cost of the sold goods go out the middle, because you're taking an average of the older and the newer, weighted average, and you're going to figure out the normal average, weighted average cost per unit. There's also one more method, the specific identification inventory cost flow. This is more for car dealerships, because cars have usually VIN numbers that they can track, unique serial numbers. So basically, when you sell a car, you can match that car on the books and know exactly how much you costed it out. So that's usually for bigger jobs like boats, cars, RVs. You'll know exactly how much it cost you. So on the dealership, their financial statement, they'll have their sale of the vehicle, and then they have the cost they paid. And so it's easy to track it. But for inventory that's just coming and going all the time, it's easier just to use either FIFO, LIFO, or the average method. Here's some examples of who would use what. FIFO is usually used by grocery stores, restaurants, fast food, any kind of food, any perishables, because you always want to sell your oldest item, your oldest food good, because if you don't, it's going to spoil and you have a loss. So always sell your oldest good in a restaurant or a food industry. That's why I always keep oldest up front. Last in, first out, an example would be technology companies, businesses, Best Buy, Radio Shack. They're going to have their newest stuff up front because that's going to have the highest ticket price, highest sale price. So it makes sense to push that first. So let's say let's say the Apple iPad 5 came out. They're going to automatically put the Apple iPad 5 in front of the iPad 4 because it's going to have a higher price, $700 versus maybe $500. They're going to want to sell the newest technology because it's going to cost the most for the consumer, and they're going to make the most sales. You see? And technology depreciates so fast that it makes more sense to sell the newest and then backlog the old and just kind of liquidate that later. Oh, sale on second generation iPads, only $199, because then they can make up sales in another area. That's when you liquidate LIFO layers, and we'll get into that in the intermediate. And then the average method is by any hardware store, like Home Depot, Ace, gasoline companies, at like Texaco 76. Basically, when it doesn't matter about how old something is necessarily, you can just mix the old with the new. So screws never go bad. So when you go to Home Depot, when they get new screws, it doesn't matter if they put the new screws in front of the old screws or in the back. A screw is a screw. It's not going to mold. It's not going to deteriorate. So you can just take the cost of all of them, average them out, and have a new cost depending on if it's increasing or decreasing. So that's examples of when you use them. I'll show you more examples because I'll go over a problem with you after I go through all the chapters. But if you're doing the homework, you'll get hopefully you'll have a table and you'll keep track of your inventory as you sell it. Because remember, here's a hint. In when costs are rising, FIFO is going to give you a lower cost of goods sold, where LIFO will give you a higher, because if costs are rising under LIFO, you're always selling the newest stuff, which costs you more. So it's going to give you a greater cost of goods sold, and you're going to have a lower ending inventory. But with FIFO, if costs are rising, you're going to have a lower cost of goods sold and a higher ending inventory. So basically, and the average method is going to be in between them. The average is going to be kind of more in the middle. So basically, when comparing the methods, FIFO usually reports higher gross profit and income than LIFO when costs are increasing. LIFO usually records less revenue, less gross profit, less net income than FIFO when costs are rising. That's why LIFO, a lot of companies use LIFO to pay less income taxes, because less income means less income tax. Where with FIFO sometimes you'll get inventory profits or illusionary profits, which are just, you get a little bit more profit, but because you used FIFO, not LIFO. And then also I'm going to talk about valuation of lower cost or market. So the cost of replacing items in inventory is below the recorded cost, or the inventory cannot be sold at normal prices due to imperfections, style changes, or other causes. So sometimes you might have inventory on the shelf that you bought for 10, but now it's only worth 9. The market's down, the selling value. So you need to go into your books and adjust your inventory for that cost. So if you had a drop of $1 in price, you're going to need to debit cost of goods sold for that loss and credit merchandise inventory. So you're bringing down your inventory to cost. Remember, as an accountant, you always recognize losses, never recognize gains. That's a conservative approach. So losses, make sure you record them, because it's always going to help you. And you always, merchandise that is out of date, spoiled, or damaged can often be sold at a price below its original cost. So let's say you had you had an item at $1,000 original cost, and you had an estimated selling price of $800, and your selling expenses are $150. So you're going to take that $800, which you're gonna get, minus what it's going to cost to sell it, gives you a realizable value of $650. That's what you're going to record it as. You're not going to take into account what it actually cost you. You're going to